Good afternoon. You are welcome. Can you, everyone hear me? If you can hear me, unmute your mic and just say hi. Okay, so Nicholas can hear me. Rosalind. Okay,
Good
Derek.
afternoon.
Yeah, Nicholas. Derek, are you there? Rosalind. Okay, Suviela.
Yes, I can hear you, Derek.
Okay. All right, Suviela, are you there? Okay, so um, let's start. Yesterday we went through a couple of materials. Let's just try and recap if there's any question so that we can answer them. Or who want to do a short recap for us? Any idea? What did you hear yesterday? Let me put it that way. What did you hear? Or what do you think you went through yesterday that you like to share with us? Any volunteer? Oh, Charlie, this one we have to. It's not going to be one way teaching. Mm, we have to share ideas. So please, I need a volunteer. Who volunteer to say something? Or everybody, in fact, everybody crash should say something. Okay, so if I'm not getting a volunteer, I'll volunteer someone. Rosalind, Rosalind, are you there? Nicholas, your mic is off on, so maybe you want to say something. Oh, guys.
Okay, so this is what I heard yesterday.
Okay.
Yesterday we talked about the domestic law that the Ghana we that the trial started in somewhere 1943, and it has undergone an amendment. So the current one that we have. And I also mentioned the four main functions of the TRE, where he said they have four main functions that are education of the taxpayer, that's through the 10. Okay. Then the assessment of the taxpayer to pay taxes and levies. Then you collect taxes and levies, and then you pay all the amounts collected into the consolidated fund. And then you made mention of the person. When you talk about person in taxation, it means four things. That's the individual's company, trust, and a partnership. And then we talk something about the section 1 of the Income Tax Act 896. And you say talk about the position of income tax. The income tax is imposed on an individual, company, trust, and a partnership. And then you make mention of the sources of income. Okay. That's in section 1 of the income tax act, which is the income from employment, business, and investment. And then you went on for the conditions for imposing tax, which is tax is imposed on one, the chargeable income, the final withholding payment. Okay. And then the same act explained to us what chargeable income means. And then you said that it's the total of the accessible income of that person for the year from each employment, business, or investment, less the total amount of deduction allowed. Okay. And then you refer us to what the accessible income means. And he said that accessible income is the income of that person from employment, business, or investment. Then we talk about resident person and non-resident person. So that's what basically I had.
Great. You've done well. Who else? Who else will give a shot? At least when we learn, we are supposed to remember them. So at least just not a vivid, but at least just a minor. Give us some Rosalind, take over. Are you there? Oh, Abena. Abena, what did you hear yesterday? Hello. Hey. Can you all hear me? Okay, Derek, I can see your mic. Okay, so maybe just tell us a little you heard yesterday.
Okay, I think my colleague has covered a lot, but I think to start with, we also you took us to the general overview of tax systems in Ghana, and I don't want to go into that, but I think the major thing was the fact that nobody has the authority to impose tax on a citizen or a person other than the Parliament of Ghana.
Great.
Then we also talk for the fact that it has gone through a lot of stages, and the last act that was 2000 at 592, which was replaced with at 896 2015. And
Mhm.
you also made mention of the fact that we shouldn't read the act in isolation. We have to read it together with the LI, because LI seeks to give more explanation to act. So in order for us to address ourselves with, we need to have it as well. Then you
Mm,
also mentioned some of the acts that we need to be familiar with. Of course,
mm,
the income tax is one that is Act 896 2015. You also mentioned of petroleum income tax 1987 PNDCL 188, and you also saw that you said that that portion, I mean, the petroleum income tax, it has been placed in the main act, income tax at 896, section 63 to section 76. We can find it over there. Then we
mm,
talk about minerals and mining at 2006 at 703. And I think
mm,
the course will also talks a lot about double taxation. And we also said that we have 14 treaties that we need to cover in order
mm,
to go through the course successfully, not leaving the VAT
mhm,
Act out. We need to also brace ourselves with it. VAT at 2013 at 870. And you did mention that before 2009, division of GRA, they were working, I mean, autonomous. They were alone.
Yeah, we are.
IRS,
You're online.
VAT, and customs.
Yeah.
Yes,
Mm-hmm.
but GRA Act 2009 merged all of them into what we have GRA, and we have
Mm,
one commissioner for them. I think
mm,
my colleague has already talked about the functions of GRA, that is the four functions, but later we talk about the payers of tax, the individual, the companies, the trust, then partnership. But I think what I will add, because since he left at a resident person, who a resident
mhm.
person and
Correct.
non-resident person is, and I think we talk about the fact that a resident person is a citizen, other than a
Mm,
citizen who has a permanent home outside and spend all the days, 365 days outside in that particular permanent home. And we talk about the fact that if the person happens to be even in Ghana for even 7 days, then the person becomes um, a resident, but not a resident. And we also talk about the fact that for a person to be a resident in Ghana, the person might have probably spent 183 days or more here
mm,
in Ghana. So if you spend 183 or more days in Ghana, then you are considered to be a resident. Then we talk about
mhm,
the fact that if a worker or an official of government has been posted abroad, that person is considered to be a resident of Ghana. And I think I also heard that even Ghana embassies outside is considered to be a Ghana land or Ghana territory for the purpose of taxation.
Yeah.
And I also heard that when we talk about a partnership to be a resident, that is if any of the partners is resided in Ghana at any given time in the
All right.
year, then the partner is considered to be a resident. We also talk about a trust, and we are saying that a trust is a resident in the country for a year of assessment. If the trust is established in the country or any of the trustee is present in the country in the particular year of assessment. And for a company to be a resident in the country, we are saying that the company is supposed to be incorporated in Ghana. Initially supposed to be an Act 1963 Act 17, but it has been replaced by Act 992 2019 recently. And we also mention of managerial decision. If the managerial decision of the country is also taken in Ghana during a year of assessment, then the company can be considered to be a resident. I think that is what I
Great,
heard.
great. I think you've done a good job, Samurai. You heard well. You've done your best. So now, what I will urge you is that you need to read in addition, so that you understand it. And then that's all. Then we are moving forward. So do your best. Okay. Thanks, guy, for the summary. So today too, we
Okay.
want to continue on, but I noticed that um please don't get lost in this whole thing that we are doing. I always want you to see it as something common sense. The whole laws and the subject and everything, it has a common sense underlying it. That's why we are learning. So sometimes I don't want you to see it as more of theoretical. You see, abstract. If you see it as an abstract, you will not understand. So we started when we're looking at the local law or the Income Tax Act in Ghana. We started by going through section 1, how tax is imposed. And like you said, taxes in the authority to impose taxes under the constitution is only parliament. Or if it is delegated, then parliament will delegate its power of making the tax law to someone. So that has its source in the constitution. So section 1 says imposition of tax. If you have a chargeable income in Ghana, then you are subject to tax on your income, or if you have a final withholding payment. So we went to section 2 to understand what the chargeable income is. So chargeable income, we said it was all your accessible income from employment, business, and investment. And those are the sources of the income that we mentioned. Now, since section 2 told us about chargeable income by introducing the accessible income, we went to section 3 of Act 896 to understand what is accessible income. So in accessible income, we're told that it is the income from all employment, business, and investment. Nicholas, mute your microphone.
Okay, sir.
Good. So we said that if the person's income from employment, business, and investment, if we put it together, that gives us the accessible income. But we didn't end there. So section 3, subsection 2 now introduce some dimensions of international taxation, because the persons that we talk there, you can have persons who are both local persons and then international people who have some international relations. So section 3, subsection 2 now give us a broader understanding of the persons that we were talking about. So it said that in the case of a resident person, the person income from business or investment or employment, even if the source has ceased, it is accessible income. So that under section 3, subsection 2, we got to know one category of persons called resident person. And so for a resident person, we tax you on your global income. So you, for example, let's say Derek, you are a resident person. Everywhere your income is coming from, if you get income from Ghana and then you are in Ghana, you also get income from United States, from maybe some investment or something that you have done, and it falls under any of the business, investment, or employment, we will tax you. Okay, and it even goes on to say that even if the source from which you got the income has ceased, we will tax you. So, for example, you were working, you were an employee, then you left, you resign your job, you got another employment. Then later they say, oh, some money has come and this is your share of the income. As long as we can trace it to the employment income, the law says we should tax you. Even if it is business and you have wound up the business is no more, but the income is now coming, we can still tax you. So the first section 2, section 3, subsection 2A gave us the understanding of a resident person. Now, resident person was not defined under section 3, subsection 2. So we had to jump to section 101 to go and learn what is a resident person. And I told you, and in fact, I think there you summarize it perfectly. Section 101 gave us 4 main subsections. So the first one talk about a resident individual. So anytime you are explaining, you need to distinguish it. For a resident individual, you need to tell the physical presence, if it is 183 days, if it's a citizen, if it's an official of the government abroad, and all those things. Those are the resident individuals. Then you can go ahead to talk about a resident partnership, where if the partnership is registered in Ghana or any of the partners reside in Ghana, then that one too is a resident partnership. Then you go on to resident trust, a trust where it is registered in Ghana or any of the trustees resides in Ghana, or even if any of the trustees does not reside in Ghana, but management decisions are taken from Ghana, then we say that is a resident trust. Then we look at the last one, section 101, subsection 4, which talks about resident company. So we're saying that if you are registered under the Companies Act, Act 992, then you are resident, or the management decisions are taken from Ghana, managerial key decisions are taken from Ghana, then you are a resident company. So we dealt with that resident person. That is section 3, subsection 2A. We now jump and go and look at the subsection 2B, which looks at the other category of persons that we are talking about, and it called them non-resident. So from section 101, if is either you are a resident or non-resident. So if you are not a resident, then you are automatically resident. If you are not a resident, then automatically you are non-resident. So we came to look at how do we tax non-resident. We've established that in the case of resident, it is all your total income, even if the source has ceased. So we tax all your global income. And the whole idea is that if you're a citizen, what again? You are our own son. So whichever income you get, bring it. Come and pay small. Let us use it to develop our nation. After all, if Ghana develops, you are part of it. Understand? But if you are non-resident, your case is a bit different. You see it, we cannot tax you on everything. And this is where we will come and introduce what we call jurisdictions to tax. Okay, jurisdictions to tax. So here we are looking at the jurisdiction. Do we have the right to tax everybody if the person is a non-resident? So in trying to tax these two categories of persons, that's the main reason why we divided the people into two. If you are not careful and you don't divide them into two, you end up taxing everybody who, in fact, even people who are on tourism. If they come to your country and they are having money on them, you are likely to tax them. So we are saying that for non-resident persons, we will tax them on their employment, business, or investment only if the income has a source in this country. So to the extent that the income has a source in this country, then we'll tax you, because it means that you got the income from Ghana. The income has a source. It originated from Ghana. If the income did not originate from Ghana, we can only tax you again if you have a permanent establishment. And I said that these things we are going to learn them very well. in as we go as the lectures goes on. So you can see that in this particular case, we have introduced two concepts, resident and then source. And we are going to learn that these are the main theories that determines international taxation. So if you want to tax me on a resident base, on a global base, then I must be a resident. And you can tax me on every income. But if I'm not a resident of your country, you can tax me only on the income that I mobilize from your country. Or if I did not mobilize the income from your country, if I have a permanent establishment in your country, then you can tax me on those ones. So I believe that let us know the distinction. So you can see that section 3 really is the key to all the international taxation discussions that we are going to have. So we look at the residents under section 101. So I'll also urge you to read section 102. Okay. Section 102, which talks about changing residence. You know, someone can change residence. Someone can change residence. So I'm not going to read this one. You read it later on for yourself. Good. So, guys, that is where we are. We are now into the arena. Now, you will notice that every country is now trying to mobilize enough money. So, for example, in Ghana, we have introduced the two concepts. We are saying that if you are a resident, for residents, we'll tax you on all income. Okay. For non-residents, we tax you only if the income has a source in the country. So here we are trying to exercise our power, exercise of power based on source. So we will come and learn something we call the source jurisdiction. So we are now going into that does GRA have power to tax? That is where we are now moving into. We have looked at the local law. We are now moving into the jurisdictions to tax, especially if we take it from section 3. For a resident person, we have jurisdiction over all your income. We can tax everything. But for non-resident person, we have jurisdictions only for the income that you collected from our country. So we have the right to tax you. If we can't tax you on the source income, then we can tax you on what we call the permanent establishment. And so I will urge, okay, so Nicholas, go to section 101 and read what is permanent establishment for us. Hello? Am I online?
Are you projecting it?
You don't have your act.
Yeah,
Everybody
but
should open
I
his
can't
act.
see.
Oh, you can't
We
see my
should,
slide.
okay. Yeah, I can't see your slide.
You can't see my slides.
Yeah, it's off.
Who can see? Who can see? Can you see? Okay, Derek.
No, sir.
Can you, if
It's
you can,
still off.
okay, Derek, can you, if you can see, then read it for us, Derek. So Nicholas, mute your own and let Derek.
I have the act as well.
But you cannot see my slides, eh?
Yes, please.
Oh, okay, hold on, because I was right. Oh, you can see.
Okay, we
Okay.
can see now.
Okay. All right. So section 101, read permanent establishment for us. But there are two of them. We have for the number 1, which is a foreign permanent establishment, and then number 2 is Ghanaian permanent establishment. Now, again, let me sound that this is according to the provisions of our local law. We are now going to see if another country also has the same provisions, then what is going to happen? There's going to be a fight. So there's going to be a conflict between the two countries. So how do we resolve such a conflict? Then we will say, okay, let us enter into a tax treaty. And just like the treaty of 1844, you remember the treaty, the Gold Coast Treaty. A treaty is a bond, isn't it? You can't easily breach it. But treaty, the bond of 1840. Yes, you remember your history very well. Why are there? So a bond is just is a treaty, and so two countries will come in together and say, okay, you know what, this is matters of state revenue. It is about jurisdictions. So let us enter into a bond and then use it to resolve the conflict. So let's look at first of all our local law. So read the Ghanaian permanent establishment for me first. Derek.
Yes, sir.
Read the Ghanaian.
Sir, please, your screen is still off.
Oh.
Okay, but I can see here.
I can't see the screen. It's off.
What can you see?
It's blank. Nothing is showing.
Ravana, what about you?
Please, I can see.
Okay, I can see now. Okay, it's fine.
Okay.
It's fine now.
All right, so read it for us.
Okay, Ghanaian permanent establishment includes A place in the country where a non-resident person carries a business or that is at the disposal of the person for that purpose.
Good. Let's try to explain this one. We will come and learn more, but let's try to explain it. So he said a place in the country where a non-resident. Now, I believe you know who a non-resident person is. So this non-resident person has a place in this country where he carries on his business. So if that person carries on business in Ghana, you see, he's a non-resident. So he has just found a place for himself and he comes to do business and then go. He will not stay here, or if it's a company, let me say even a non-resident company, he's not registered under our local law. Decisions and management things are not done here. So we cannot say he's a resident. But the guy still carries on business in Ghana. Don't you think that we should find a way of collecting some tax from him? We should. So if you are non-resident and you have a Ghanaian permanent establishment, which includes a place in this country where you carry on your business, some way, somehow, we have to tax you. For example, he has a satellite. Okay, a satellite that can provide, let's say, telecommunication or internet facilities to Ghanaians. They pay online. Okay, they pay online. So you will not, GRA will not even, you won't even find any office for this guy. Yet this guy is making business, millions of cedis. So we should find a way of taxing him. So we are saying that if a non-resident has a place in this country where he does his business or it is at his disposal, then he is deemed to have a permanent establishment. He has an establishment or he has established himself in some permanent way in Ghana. We are going to learn this thing in detail in our treaty analysis. Okay, read on.
B, a place in the country where a person is using or is installing substantial equipment or substantial machinery.
Good. So you don't have a business, but you are installing some serious equipment, undersea cable and other things in Ghana. this one too can also be considered as what? A permanent establishment. C.
C, a place in the country where a person is engaged in a construction, assembly, or installation project for 90 days or more, including a place where a person is conducting supervisory activities in relation to that project.
Good. So let's assume that you are a Burkinabe contractor, Burkina Faso, then you got some job to come and do some drainage. You don't have an office here. You only come buy the cement and then you start all your things. We are saying that if the project lasts for more than 90 days, we should see you as what? Having a permanent establishment. Let's say the contractors who constructed the circle overheads, assuming that and they are Brazilians, isn't it? So assuming that they didn't have an office in Ghana and they are coming to do the overhead and go. We should, if Ghanaian companies are paying taxes, then they must also pay tax if their construction lasts for more than 90 days. After a 90 days project there, then it's not a small project, or you don't think so? So that's some of the reasons we should find a way of taxing them. So if you are engaged in construction, assembly, or installation projects for more than 90 days, then we will see that activity as you having a permanent establishment. D.
D, the provision of services in the country.
Good.
E,
if you provide services in this country, then we should also see that as you there, you come. Then you come and render advisory. Then you come and go. You don't stay here. You are in a hotel. You do your thing, then you pack your things. You come with a briefcase. You come and meet your clients. Then you give them the report, or you advise them. Then you go. That should also be counted as you in Ghana. Continue.
E, a place in the country where an agent performs any function on behalf of the business of a non-resident person.
Good. So here you are not coming, but you have an agent. Okay, and this one we are going to look at the controversy as around it. See, we are still in our local law, but when we start considering other countries' law, you see the controversies that may come. So in the tax treaty, we are going to learn these things. He has an agent and he's performing functions for him in Ghana. It's the same as the non-resident person coming to Ghana. So we are saying that under that circumstance, you should be considered as what? A permanent, as having a permanent establishment. And this one includes, in the case of insurance business, the collection of premiums or the insurance of risks situated in the country. So you are a non-resident insurance company. Let's say Talo has insured their assets because they couldn't find any insurance company that can pay them compensation if something happens to their assets. Now Talo house has been paying premium to the company outside Ghana, and they have agents who collect the premium for them. We will see that insurance company as having a permanent establishment in Ghana. Okay, but this agency matter does not include a general agent of independent status with its own legal personality acting in the ordinary course of business. Okay, so if the person is a general agent, that is an independent agent. In that case, you cannot. I do my own stuff, and so you cannot consider me as an agent of the person. And then the last one is an owner. There was a February 2016 question where you were asked to explain Ghanaian permanent establishment for 10 marks, then foreign permanent establishment for 5 marks, and owner for 1 mark. So the total marks was 16. And in fact, if they ask you to explain or what is, please, this is what the marking scheme said was the answer. So you need to reproduce this thing down for us. Okay. There are about 1, 2, 3, 4, 5 conditions that we consider as Ghanaian permanent establishment. If you write and you leave one out, it means that you couldn't write everything. So please take note of it. So Derek, these are the instances where we will ask you to tell us what the law is saying. So that is Ghanaian permanent establishment. Let's look at foreign permanent establishment. So you see, with a Ghanaian permanent establishment, is a non-resident, non-re doing something in Ghana. But let's look at a foreign permanent establishment. It's going to be the other side, where a resident Ghanaian or a resident person doing something outside Ghana. So let's look at foreign permanent establishment. Read that one too.
Okay, foreign permanent establishment means a fixed place of business of a resident person situated in the foreign country where the business is conducted continuously for at least 6 months, but excludes any place at which only activities of preparatory or auxiliary nature are conducted.
Good. So you can have a Ghanaian or a resident person who is also doing business outside. And like the construction that I said. So we have a contractor in Ghana. He got some job to go and construct something in Burkina Faso. So the whole thing lasts for about 6 months. Then we can see that one as a foreign permanent establishment. The whole concept is that he did not entirely get the whole money from Ghana. So that would be like a foreign income. But of course, that 6 months does not include all the preparatory or auxiliary activities that he does. So let's note these things, and then we will answer the questions when they come. Good. So we know now the sources, isn't it? It's either if you're a non-resident, we either tax you on your what? Your resident, your source income, or we tax you on your permanent establishment. Do you notice that the permanent establishment is just like a business in Ghana, isn't it? So we just trying to replicate someone who is doing business with some a non-resident person who says his business is not in Ghana, but more or less he's doing business. Good. Any question at this time? I'm open for questions. So Suviela, ask me a question. Or Rosalind, ask me a question. Ibra, any question?
No, please.
Hey, are you sure you understood it? Okay. All right. Let's move on. So we are going to look at sovereignty. When we say sovereignty, you understand. Tax sovereignty. We've explained it partly. But when we say tax sovereignty, we say Ghana is a sovereign state. Is that not it? So sovereignty, we are trying to look at to what extent does Ghana have power, or parliament have power to raise tax revenue. So you can see that the way we have defined our residents, we are trying to exercise some power. If you are non-resident, Ibra, don't worry. For permanent establishment, we are going to do it fully. At this point, I only want you to know, Ibra wants me to recap the permanent establishment, but don't worry. We are going to look at the permanent establishment in full under Article 5 of the OECD Model Tax Convention. At this point, all I want you to understand is that we have two main angles, or two main powers to exercise. If you are a resident person, we have the power, we have the sovereign power to tax all your income. Okay? And if you are non-resident, and as long as your income was sourced in Ghana, international wise, we have the power to tax that income. And that is what Section 3 of our Income Tax Act deals with. Okay. So now we are trying to, when we say tax sovereignty, we are looking at to what extent do we have the power to tax somebody? Okay. If you don't have the power to do something, the person can challenge you. But if we have power, then we can do that. So traditionally, most countries try to exercise all their powers where they may raise enough money. You can see that in Ghana, GRA is always looking for money to meet the revenue targets. They are saying that GRA has not been collecting enough revenue. GRA has not been collecting enough revenue. So if some money is lying somewhere, do we have the power to tax such? And considering the importance of revenue in every country, if a country has the power to tax, they will easily exercise that power. Okay. So let us now look at the two main arms. And I believe that from section 101, what we have read, we now look at the jurisdictions to tax. So do we have the right to tax somebody? So we are talking about taxing rights. You see, from section 1, we said imposition. If you don't have the right to impose, especially if I'm not your resident, on me, then trouble comes. You cannot impose it on me. So specifically, we have established that there are two main reasons why, or two main acceptable ways that taxes can be imposed on your resident income or your source income. Please don't see it as too much theoretical. So you see what we have learned there, what we have learned under section 3's resident and blah blah blah. That is the same thing that we are talking about here. You can see it's either source or what? Resident. And with the source, we are talking about non-resident. Is that not it? Non-resident persons, their income. So it's either source in Ghana or it's a permanent establishment. Permanent establishment is where the person is not having the physical place in Ghana, but we can deduce that the person is actually undertaking some business in Ghana. So we put, in fact, the permanent establishment activities are almost just like the resident one. So the two principles that we have always advanced is that as long as you are resident, all your income will be taxed, irrespective of where the income is coming from. Please, I need you to understand this one. And that is what exactly we did under section 3. That is how our law was drafted. So section 3 is saying that if you're a resident person, your income. So that is one way we exercise our power or the jurisdiction. The second one is the source jurisdiction. Okay. So if you are not in our country, in other words, you are not a resident person, but you're present or you do business in our nation or in our state, and that activity gives you some income, we can also have jurisdiction over that income. And that is exactly what we have done to the non-residents under section 3. Now, let's look at the residents and the source principles. Any questions so far? These are very, very important concepts that I've introduced. The source jurisdiction and then the resident jurisdiction. So please ask me a question before I move on.
Okay, so Francis, please, I want to be clear on this one. For a resident person, so far as you're a resident person, meaning you are a citizen of the country, or you have a permanent residence.
Hey, if you mention a citizen, then you are looking at only one type of person. So you are looking at individual. What about a company, resident company?
Yeah, so I'm just trying to give an example that if you're a resident person, which comes with 4 conditions for you to be a resident person, and then you don't even conduct the business here, we have the right to tax you.
Yes, as long as you're a resident person, we don't look at where the income is coming from.
Okay. And then the first jurisdiction is saying that you might not be a resident person, but so long as you can trace a source of your income from Ghana, then we are able to tax you. Is that a principle?
Correct. So these 2 principles guide the international taxation. You get it? So in fact, almost the whole world, that is how we have, in fact, that is how they have built their, tax laws. So either a source or resident. Okay. Any other question? Any other question? Oh, it means I can proceed then. All right. So if you hold on to this, you are a resident person, I can tax you irrespective of where the income is coming from. Or you are a source, you are a non-resident person, I can tax you as long as your income is sourced from my country. You notice that if you hold on to this principle, there's going to be what we call overlap and vacuum. You are going to have jurisdictional overlap and jurisdictional vacuum. Now, what do we mean by jurisdictional overlap and then jurisdictional vacuum? We have said that the core set of principles relating to jurisdiction, to the extent to which a country can tax, is based on these 2 principles, source and residence. But there's a problem. Did you notice that in defining what a resident person is, they were using some connecting factors? They were using some factors to connect the people to themselves. Let's go back to section 101 and let's look at what can we use to connect people and we can call them residents. So go back to section 101 and I want Derek, you can read it for us again. Let's even look at the first, the individual residents. What are the connecting factors that we use to connect the person? So go to section 101 for us.
From the Act.
Yes, from the Act.
Okay.
Let me see if I can project. Yeah, 101. Who a resident individual is.
Okay.
Subsection 1.
Okay. An individual is resident in the country for a year of assessment if that individual is a citizen.
Good. So let's hold it there. Let's hold it there. Have you seen one of the connecting factors? We are trying to connect people and we want to bring them into a net so that we can call them our residents. So first we are saying that if you are a citizen, that is one factor we can connect you to our state. In other words, you must hold some allegiance to the state. And as a citizen, we hold allegiance. Is that not it? So you remember there was a case in this country where they say if you hold dual citizenship, you cannot hold some certain positions. You remember that? How many of us know that? If you have a dual citizen, there was a time like that. If you are a dual citizen,
you can't be a president.
You can't be a government official.
Good. The reason
or a
is that
president.
then good. The reason is that your allegiance is divided into two. You don't hold a proper allegiance. So we use these connecting factors to connect the person to ourselves and say, look, as long as you are a citizen of Ghana, you are our own. So those are the connecting factors that we are talking about. The second one is present in the country. So here we are looking at your physical presence in the country for 6 months. The whole idea is that if you have stayed in Ghana for 6 months, then you have participated in the economic activities for long. So then you should be treated as a normal citizen. You have enjoyed the police, you have used our roads, the subsidy and everything. You have enjoyed enough. So you should now be considered as a citizen. Look at the C for me.
An employee or an official of the government of Ghana posted abroad during that year.
Of course, for these people, they said their allegiance is already, we have connected them already, isn't it? And then
Yes.
the last one says a citizen who has who is a temporarily absent from Ghana, and you have a permanent home. If you have a permanent home, then it means that you have a lot of economic activities. Your social ties are in Ghana for long. So, guys, what I'm trying to say is that if we use these connecting factors, we're able to connect the people to ourselves. But there's going to be an overlap, because the same way you are, even if you look at the number 2, okay, number 2, which is you are not a citizen, but you are physically present in Ghana for 183 days. The same
Okay,
way
Boss
you
Francis.
yeah.
With respect to the B, what about assuming you are indisposed, so you cannot be, physically present in the country, but you send somebody to come and act on your behalf, or that one cannot be considered because we are in a situation where, or here we are dealing with the person in particular.
Yes, the person in particular. So are you saying that, for example, an individual and you want somebody to come and do your job for you as an employee? So you see, that's why we distinguish all the residents into 4. So we have different connecting factors to the people. Okay. So for a company, what are the connecting factors? We are saying that the first connecting factor is that you must be registered in Ghana. So we go to the Registrar General, we will see it there. If we are unable to connect you with the registration, we should be able to connect you with decision making. So all the managerial and the executive decisions are taken from Ghana. So if we have the MD sitting in Ghana and making all the decisions, we can connect you. You understand? So I was even talking about the first B. The problem, I'm trying to explain the jurisdictional overlap here. If a country tries to hold on to those principles and say, okay, residents, I'm holding on, you are my resident, so I have the right to tax you, and you hold on to that resident principle, somebody can be dual resident. Have you seen it? So
yes.
If the person is a dual resident, how do you deal with such a person? That is what we call the jurisdictional overlap. There's going to be a serious overlap. So the person, the resident overlaps in 2 nations. So he's both a citizen in Ghana and a citizen in UK. How do you deal with such a person? Are you going to tax him here and also going to tax the income there? So assuming that the income, each country is 40%, no, 70%, if just hypothetical. If the income that you get, they take, let's say 60%. So Ghana will take 60%. UK will also say take 60%. So how do you deal with such a situation? So that's what we call jurisdictional overlap. So you see the problems you are going to deal with in international taxation. So how do we resolve such a problem? They exist. So how do we resolve them? You are saying that the person should be physically present. Okay, he's 183 days here. Then he's also another 183 days over there. So equal. How do you deal with them? You are saying that a company in our law, we are saying that a company, if it is not registered here, and the management decisions are taken from Ghana. Okay, we'll go ahead and consider you as a resident. We tax you as a resident. Then the other country where it is registered will say, okay, me too, registration. I will take registration as a connecting factor. So you are registered in my country, so I'm going to tax you over there. So you see the problem. Then the guy is in a very tight corner. So would I do business? I better don't. Then I better don't do business, because why would I get my money and then each of you are coming for everything? So you get it. So under that circumstance, we are going to run into problem. Okay. So that is what we call the jurisdictional overlap. We can also enter into what we call the jurisdictional vacuum. Okay. Jurisdictional vacuum, where the person will plan his life in such a way that he will never be a resident in any of the countries. So I see that the physical presence in Ghana is 183 days. Okay, I spent 6 months, I spent 3 months here. Then I pack my things. Then I go to another country. They have another 183 days. I spent 3 months there. Then I go to another country. Then they have 183 days. Then I move. So you see, I can move around for the whole year. I'll be residence. How do they call it? Someone who has no residence. So under that circumstance, what do you do? So there's going to be a vacuum. So all these problems, we have to find a solution to it. And as tax expert, that is what we are going to do. So most of the theories that we are going to read, they center around some of these principles. Any question for me? Guys, if you don't ask question, it means I don't understand. Okay, Nicholas.
Please, I'm a bit confused.
Don't get
For
confused.
the jurisdictional overlap, you are saying that the person should have like a dual citizenship, right? Is that the only factor?
No, if you go to section 101, citizenship, don't you know that some people, they are not citizens of any country? Do you know you can renounce your citizenship? You know that?
Yeah.
Nicholas? Yes, you can renounce your citizenship. And if you renounce your citizenship, you are not a citizen of Ghana anymore.
Sure.
In fact, you can be a citizen of UK. You know that?
Yes.
Good. If you don't want to hold dual citizenship, you can be born a Ghanaian, but you'll be a citizen of UK. That is why some players, they have been playing for the foreign teams. I hear Balotelli cry. He's a Ghanaian. Balotelli, you know Balotelli?
Yes, you are Balotelli.
Mario Balotelli. I hear he's a Ghanaian or something. But he's now in Italy. Is it Italy or Germany? I've forgotten which country he plays for. Yeah. His father, his descendants are from Ghana, but he has transferred.
Timor, follow football small.
Oh, Charlie. You see, so you can see that such a guy has he's gone. So you too, today, if you go to US and you go and get their green card, you are a citizen of US. Though you have been here, you've been studying local tax. So it cuts across. You can have overlap everywhere. People who have dual citizenship, people can also decide not to have any citizenship at all. He will renounce his Ghanaian citizenship, and then he will not go and take any other citizenship. So you can have vacuum, and you can also have overlap. It exists. Do you understand it now?
Yes, sir.
Yes.
So the major problem has to do with the residence one, where we are going to have dual residence. So in such a case, how do we deal with such a problem? We can only deal with such a problem if the two countries come together and say whether jurisdictional overlap or jurisdictional vacuum. Let us enter into a treaty, a bond. Okay, so we are going to call it tax treaty or bond. If we enter into a bond because you want to exercise your right over this guy, so Ghana wants to exercise its right. UK also wants to exercise its right. So there is a conflict of rights, is that not it? UK is saying that he's my resident because he's a UK citizen. Ghana will say he's a resident in Ghana because he has been here for 6 months. So we need to find a solution. The only solution will be that the two countries will come together. When they come together, then they need to enter into a treaty. That treaty will help them decide on the allocation of the taxing rights. Do you get it now? So you see now we are from section 3, this resident concept and source concept is pushing us. Now we are now into a conflict where somebody has dual residence. Two countries want to tax him. The person will be crashed out. If it happens, he's going to be taxed twice. So under that circumstance, what comes in is double taxation. Nobody wants to pay tax twice. So we go into a treaty so that we can allocate the taxing rights. And a treaty is like a law. Okay, it's like a law that binds the two countries so that they can allocate their rights. Now, before you go to the table of treaty or before you go to the treaty negotiation, there are some principles that are very, very important. You must know, if I'm going to the table, which one do I take and which one do I give up? Because we are now seeing that there's a conflict, we need to share the rights. So if Ghana and UK are going to sit down and say, okay, to avoid this double taxation on the dual residence of the people, let us look at source income. How do we deal with it? And resident income. How do we deal with it? So for source income, we are saying that the primary jurisdiction to tax is asserted by the nation when it claims that the right to tax income, irrespective of the jurisdiction's claims of the other nation. The source. Here, international wise, we are saying that as long as the person is getting the income from your source state, that person, the state which has a source, should be the state that should get that income, that should get the tax. In other words, where the income is being sourced from should be the state that should have that right, the first right to tax that income. Do you understand it or do you agree? Everybody is quiet.
I agree. I agree in the sense that somebody might have registered a business at your end, but did not get a contract in that country. Maybe the person came as far as getting a contract in Ghana. So that is where the income is coming from. So the person should have the first right to tax.
Good. So in the this thing, we are going to in the treaty we need to identify primary jurisdiction and then secondary jurisdiction. Who has the first right and who has the second right? Okay. So these are some of the things that we are going to look at when we go into treaty. Okay, so I think that is it for now. Any question for me? Now you know how the local law started, how the local law veers into resident and non-resident, how our local law tries to exercise its power over the income of these persons by distinguishing between a resident person and non-resident person. The problems that we are likely to encounter when we are dealing with the jurisdictional overlap and jurisdictional vacuum, and then the solution. The only solution for this section 3 problem, that is resident and non-resident, is that we need to enter into a treaty, a bond. And if we enter into a tax treaty, then we are now going to allocate the taxing right, especially when there is a vacuum, or the taxing right when there is overlap. Suvila, ask your question. Unmute your listen and ask your question. Suvila, we are listening. Hello.
Hello, Timur.
Yes. Suvila wants to ask a question.
Before she gets away to, can I go ahead?
Okay. Yeah, you can ask your question. So Suvila, get ready to ask your question. Okay, so Derek, I'm listening to you.
I think one of us asked a question if you could make the slides available. There's an option, there's a space for files to deposit on this team. I don't know if you can use that to assist us with that.
I'm sorry, I don't understand.
So when you come to when you log on to the Microsoft team,
Yeah.
are you with me?
Yeah.
In your bid to try to connect, there's a place for general something. When you go there, we have a column for files.
Oh, you mean the slides?
So when I tried, it told me no file has the slide. If you deposited there.
No, the slides. Eben, the slides. I've shared it already. So I'm just presenting. Yes, I've shared it on the platform, so you can pick it. The same slide. All I'm doing is just writing, doing some small writings, which is just the same. I mean, there's nothing new. So as for the slides, if you don't have it, we can share with you later. Okay.
All right.
Good. So Suvila, ask your question. Suvila, yes.
Hello.
Yes.
My question with respect to
the Eben, mute your microphone, eh?
Okay.
Okay, so let's hear you.
With respect to the jurisdictional vacuum, if an individual does not belong to any of the categories or decide not to be a citizen of any of the countries, does it mean that the person is offering himself for a double taxation?
No, he's rather trying to avoid being taxed as a resident. Okay.
Yeah.
Because he needs to be resident before he can be taxed. So if I am not a resident in Ghana, you cannot tax me. You see, in Ghana, non-residents are taxed. Non-resident employees are taxed 25%, and non-resident individuals, they are taxed 25%. But if I'm a resident person, my tax can go as high as 30%. No, Ghana, the maximum rate is 30%. It used to be 35.
Oh, okay.
So I can be taxed at 25% by remaining non-resident. So if I don't want to be taxed higher, then I find a way of not being a resident of Ghana. So I come and do 3 months here. I've not met the 183 days, so you can apply the 30% maximum to me. Then I move to Cote d'Ivoire. I go and stay 3 months there. Then I move to another. So you see, I'm planning my life. Then I'm going, then I'll be moving. And in fact, in our part of the world, we don't see this one. But if you go to UK, the concept of resident is so key. There was a case I read where the man, it was left with 1 day for him to be a resident person. You know what he did? He traveled. He intentionally traveled. He left the country, and the matter went to court. And his case was that he didn't want to be a resident so that he would pay the highest tax. So 1 day can make a lot of difference. So, and under that circumstance, you are going to have a problem.
Yeah, but looking at the situation, you realize that it is very impractical because you yourself, you need to be resourced, because if you don't have money, how do you make the arrangement to travel? So looking at, I think that the minority of people will be able to do this. The majority cannot do it.
Sure. But and it is only normally it is the rich people who employ tax consultants to help them plan their affairs. You understand? Especially those who have a large estate. If you are a UK person, you have a large estate, you make a lot of money if you plan this. I have some cases I'll share with you, and then you see how this resident concept has been, utilized by some people. He would decide not to be a resident just to avoid the payment of the tax.
Oh, okay.
All right. So having understood this one, we are saying that how do we resolve this international? Yes.
Please follow up to the question the gentleman asked. So in this particular case that he's been able to the concept of residence or the principle of the source is going to be used, right?
Yes.
Okay. All right.
So we'll use the source. We'll use the source to tax him.
Okay.
And normally the source rules are a bit relaxed. The source rules are a bit relaxed. For example, if you earn a business income in Ghana, the maximum we can do is to take a withholding tax of say 20%. Okay. That is a maximum. But if you're a company, would have taxed you around 25%. So it depends on the tax rates and the tax situation in a particular country. You can really make money from this source or the residence principle.
All right.
Okay, so
hello, sir.
Yes.
Sir, can you also be a situation whereby, let's say, two countries can come together to say eliminate this kind of taxes?
Correct. You have to do that through what we call tax treaty. So that's what we are going to look at. So we're going to look at this one and then see how we can resolve it. So aside the fact that we want to do the taxing right, we want to allocate the taxing right in tax treaty. There's also the what do you call it? Avoidance of double taxation. So they can eliminate this particular type of tax. And so this particular type of tax here, we are not going to deal with it at all. We will not tax it. You understand? So we're going to now see how do we resolve this international competition among countries, either overlap or vacuum. In fact, vacuum is good because when we enter into a treaty, we can tackle the people. We can attack them and catch them. So what is tax treaty? So I'm moving into the second session. Sumiela, you wanted to ask a question. You did not ask. You said you wanted to. Please mute your mic and then talk. Or mute your mic. Even kindly mute your own for me. Subiela, unmute your mic and ask the question. Can you hear us? Okay. Okay, I can see your mic is on mute. So talk now. Hey, we can't hear you. All right. I think I need to get you people. I need to come and sell to you TableNet. Those of you who are using slow 2G internet. Okay, so guys, let's go into tax treaty. Please, this one you have to know it. I can say it covers like 50% of your exams. Okay, and we are going to use the OECD Model Tax Convention. The OECD Model Tax Convention. Tomorrow is a lockdown or a lockdown or a lockup or whichever. Please, those of you who don't have the book, I don't know how you're going to get it to. I thought you were going to pick it today or yesterday, but it didn't come. But never mind, it's still not too late. You can send Okada. I can share my location. If you come, I will give you a copy of the book. Then you go and read it, because we are going to start using the OECD Model Tax Convention. So if we say a treaty, we are saying that it is a formally concluded and ratified agreement between two countries. Now, if it is between two countries, we call it bilateral. You see, anything between two people, we say bi. And if it is between two or more countries, then we call it multilateral. Okay. So that is a treaty. So we've said that the essence of this treaty is that somebody can be a dual citizen, so which means that the person is going to pay double tax twice, what we call double taxation. Or somebody can decide to not to belong to any state at all, so he will not pay anything, so he will evade tax, so there will be tax evasion. So countries will come together and say, let's agree in an agreement, in a ratified agreement, so that any matter concerning taxation will be dealt with. So tax treaties are specifically tax matters, and you can have bilateral treaty or a multilateral treaty. Okay, so I'm going to ask a question, so I will expect you to unmute your thing. What do you think this African trade something is going to do? Do we need a multilateral treaty? Do you know the African trade whatever? I don't even know the full name. Do you think there's going to be a need for multilateral? Any views? Rabna?
I think if it's a case concerning Africa, then it should be a multilateral. That is because if we use bilateral and two countries go into, let's say, maybe Ghana and Burkina Faso goes into an agreement, another country and Ghana can also go into an agreement that will also affect the other country like Burkina. So I'm sure multilateral in this situation might be necessary. That all the countries will come together and then they decide.
So we need a multilateral treaty, right?
Yes.
Okay. Eben, you wanted to say something?
I think it's
okay. Derek, what's your view? Do we need a multilateral treaty?
Yes, we will need a multilateral treaty. Even I wanted to even touch on if you look at the echo that they were proposing, Yeah, I
Mm-hmm.
mean, it has to be a multilateral agreement between the party states. If not, it will be very difficult. Yeah, that is why a lot of West African states were coming together to ensure that they push it through.
Okay, so the question then is, why do we go into tax treaty? So please know this one. They have been asking questions on it. Okay. As for this one, if it comes, you should be able to list them and explain. So the first objective is to avoid double taxation. So Timor is a Ghanaian. He's resident in Ghana. He's also resident in UK. So Timor has dual citizenship or dual residence. So Timor gets income of, let's say, 100,000. UK is saying that their tax rate is 40%. Ghana is saying that their tax rate is 60% on the gross amount. So you see, these two countries, they've taken all the money. Now I am left with what? Zero. So certainly, this is an overlap, jurisdictional overlap. And if the countries are taking all the money, I better sit home and then fold my arms. So the first is to avoid double taxation. The second one is to prevent evasion. And so here we are talking about vacuum, where somebody can stay 6 months here and let's say less than 6 months there. The person will evade the tax. He will not pay the tax. So for example, if we have multilateral, okay, multilateral. If you stay in country A, country B, country C, you stay here for 3 months, 3 months, and 5 months. And let's say even there's another country D, and then so 3 months, 3 months, 3 months. You have achieved your 1 year, okay, but you have been able to beat the system because you are non-resident in all the other countries. Meanwhile, you are supposed to be a resident of one of them. So through the prevention of tax evasion, and even due to the exchange of information within the treaty, we are going to now learn everything about treaty. We will be able to tell if there's evasion, and then each country can assist in preventing evasion. The third one, we are saying that it is for the allocation of tax jurisdiction. So we agree, okay, if there are 3 taxes, okay, Ghana take A, UK take B, and then we are not going to tax the item C. So we are going to allocate the taxing rights within the treaty. We will sign, everybody will sign the agreement, and then we will see, say, okay, A is going to be taxed, you take this, I take this, then we move on. There's no conflict between the two states. Exchange of information, we are going to learn, is one of the articles in every tax treaty. So we are saying that if we sign a treaty, we can exchange information among ourselves. And to investors, it becomes very certain for countries, for those investors to enter. So the first thing is, if I want to enter into any country, I ask myself, is there a tax treaty between the two countries that I can take advantage of? If there's no tax treaty, I'll not go invest there. I will invest in a country where everything that I've paid goes in, everything that I've earned goes into taxes. I won't do that. So the objectives of going into a tax treaty is therefore,
Sir Francis,
yes,
will the exchange of information assist in prevention of tax evasion?
correct. Because if you are hiding something, so Derek has properties in Ghana. Derek, instead of Derek to disclose it to the UK tax authorities, Derek said he doesn't have anything, non-disclosure. But the GRA has information on it that you have businesses in Ghana, but you fail to disclose it in UK. So in the tax treaty, the UK government can invoke that provision and say, okay, Ghana, I need information on Derek. So please share his tax returns with us. Then they go and pick your tax returns in Ghana. Then we see plenty money from business A, B, C, D. You have presented your account. You have, it's a group of companies, but none of those things were disclosed in UK. Under that circumstance, we can catch you. You are evading tax. So exchange of information is very important, and you can even have investment. If you are resident in Ghana and you have investment abroad, we are supposed to tax you on all your income from investment, business, and employment, irrespective of where it is coming from. You didn't disclose it in Ghana, and you see, practically, if the GRA is able to enforce some of these treaties, those politicians and those individuals who have huge investments outside, we can catch them. They are supposed to disclose them and then pay tax here, but they never disclose them. The monies are the incomes are there. They will use it to buy goods and ship them here, and then the thing will appear as if it's a stated capital, a business. But meanwhile, the thing is not. So that is the exchange of information for you. Any other question?
Okay, and certainty of tax treatment to investors. This
Yes.
benefit the investor or the state.
No, it both. Because if investors are certain, what do you think will happen to your country? They will troop in, isn't it? Like GIPC have been doing. GIPC has a lot of tax incentives, so they go there. They go on roadshow. Please, even the president will be going around. Please bring investors, vice president. They will say, "Oh, investors, please come and invest in our country." And recently, how do you call it? The homecoming that we did. What's the name, Cry? Year of return. Year of return. You see, we're preaching that the guys should come and they should come and set up and invest in Ghana. If they come and set up and they invest in Ghana, of course, the government will say they have created jobs, or they have made enabling environment for creation of jobs. And that's also a political point. So they are all objectives of tax, the reasons why we go into tax treaties. Any other question? Okay, so please watch it out. They can ask you in exam, saying. Okay.
Okay.
Okay, so tax treaty is a constitutional matter. In fact, a treaty is a constitutional matter. Is any of you having your constitution there? Who has a constitution? The person you read Article 76, 75 for me. Who can get us a constitution? $1992.
Article 76.
75. You have one, eh? Okay,
Yes,
read
I have
75
one.
for us. And read Article 75 for us.
Okay. Article 75. Execution of treaties.
Eben, mute your mic, eh? Hey, is Eben here?
No,
He's
my mic
going
is
to
off.
cook. Okay, I've muted him. So, Derek, you can talk now. Article 75.
Okay. Execution of treaties. That is the caption. 75.1. The president may execute or cause to be executed treaties, agreements, or conventions in the name of Ghana
Good.
2.
He mentioned treaties, isn't it?
Yes.
So what he's saying is that the president, our president, may ask that a treaty or convention or whatever be executed in the name of Ghana. 2.
2. A treaty, agreement, or convention executed by or under the authority of the president shall be subject to ratification by A. Act of Parliament, or B. A resolution of Parliament supported by the votes of more than one of all the members of Parliament.
Good. So when we say treaties are constitutional matters, then what we mean is that treaties have something to do with the constitution, and it depends on the states, the general states, the law, or what the constitution is saying. So we have two main constitutional provisions. If you are a monist state, we call it monist, okay, or you are a dualist state. So for the monist state, domestic and international legal order are mono, that is one, such that double taxation agreements has direct effect and so automatically forms part of the domestic law. Here, you don't need any approval or ratification by Parliament. So, Derek, what you have read, what it means is that if the president causes to be executed for Ghana, and the second one, which is a vote of all or something by parliamentarians, does not occur, that treaty is not effective. In other words, the Article 75 must be fulfilled. So, because of that, we can have a treaty signed by the president, but Parliament has not ratified it. So that makes us a dualist legal system, which means that the domestic law and the international law are separate from each other. And there is a need for a domestic legislation or some act to be done to give effect to the double taxation treaty. So Ghana practices the dualist legal system where international agreements, international agreements must be ratified by Parliament. So please, if you see a treaty and it is being signed but not ratified, it is not effective. It doesn't work. It exists, but it is not effective because the constitutional provision has not been met. You remember recently there was it a Mahama time when he signed some agreement, and I think with the US military or something, and then the minority were saying that the agreement was supposed to come to Parliament for them to ratify it. They were talking in terms of Article 75. And then again, in Kenya, the government signed some treaty. When they signed it, the treaty was not ratified. Then some investors started enjoying or benefiting from the tax treaty. Then the tax authorities in Kenya said that agreement had not been ratified by Parliament. So what happened was that the matter went to the Supreme Court, and the Supreme Court said that, look, the constitutional provision has not been met. So the agreement was invalid. So let's note this provision as well, and then we can understand better. Okay. Any question? Any question? Okay, so treaties and conventions, we are going to use a model convention. When we say model, like a template, a template. There are three main templates or models for entering into a treaty. In other words, if you want to enter into a treaty, you can look on that model and draft your own. Okay. In the UK Chartered Institute of Taxation, sometimes they can ask them to draft a treaty. We have one full question that draft a treaty. What will you include in your treaty? But in Ghana, they won't go to that extent. But there are three main models. So a model generally provides a framework, like a template for you to. So you just go and put in your name and other things so that you can have your tax treaty ready. Then you take it to Parliament for ratification and it becomes a law. So we have the UN model tax treaty. We have the OECD one, and then we have the US. US have their own. You know, those guys, they are always superpower. They want to demonstrate that they are unique. But the most widely and the most influential one is the OECD one. OECD model. Okay, the UN, and this one is, okay, the full meaning of, who can tell me the full meaning of OECD? Organization for Economic Cooperation and Development. This one is for developed countries. And then the UN one is for developing countries. So the most influential one is this one, the OECD one. So we'll be making reference to this OECD model most often. The UN one, the US one is mostly for US people, US companies. So please, for example purpose, the UN one is just like the OECD one, but this one is for developing countries. So the question is, if there's a developed country template there, why don't you go for the developed country template and then ignore? So the UN one is more relaxed, okay? And it is in favor of developing countries. So assuming that Ghana and Germany wants to sign a treaty, the UN is advising that we use the UN model, because the UN model is mostly, they look at the situation of the developing countries so that they don't get bullied. So we'll be using the UN, the OECD one. And so at this point, let me say it is this book. This one. That's what we'll be using. This is the UN one. And this is the OECD one. So how many of us have bought it yet? Or how many of us need it during this close down? How many of us have it?
I do.
Rose? Okay. Derek?
Yet to buy.
Please,
okay. Rosalind?
I don't have it.
Okay. Sunviela? And Nicholas?
But I need one.
So?
So I'll get one from a friend, but I'll buy it.
If you have
if
you get one for a friend, that's fine. They are all the same, but make sure that it is the 2017 version. You see, we had the 2014 version. We are not using the 2014 one. The 2014 has been changed and a lot of things have been added. So we'll be using that one.
Okay.
So we are going to learn everything in this book. Everything. There are about 31 articles. It has about 631 pages. We have to finish this one in 5 weeks or 4 weeks. Now, the approach that I will use is that when we start, we will share some of the articles. And then you go and read and come and present on it. You will share with us. So you share with me your presentation. Then we will learn it all together. So guys, it's not difficult. After we finish with the treaty, then we go to the transfer pricing and we'll finish very soon. So Nicholas, mute your mic. Any question for me before I wind up? And I hope you guys are home. You are not going out. You're not supposed to go out. Any question for me? If no question, then I think I will end here. Any question?
Sir Francis.
Yeah.
So in an essence, assuming they will be presenting us with a case in which we have to deduce and analyze with respect to
Exactly. Exactly. That's what we are going to do. So we can present the case on, let's say, resident, Article 4. When we start learning Article 4, you see the problems that Article 4 can present. How do we resolve dual residence? So we say maybe Timor is a resident in Ghana. He also works in UK. He has this income. He has blah, 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 plenty. Advise Timor. Or a company. The company is registered in Ghana. They operate a website and the sales occur on the website. The management decisions are taken from Ghana, but the offices are not in Ghana, blah, blah, blah. Advise the company whether they are resident in Ghana or not resident in Ghana. So all these facts will be put together and then you are supposed to answer them.
So
this is what
it's
we're
like
doing.
a case study.
Yes, purely case study. It's not a case study, but they are scenario questions.
Yeah, scenario questions. And again, you see, like I said the other time, it is easy for you to recall some of the things that we are learning here. It is very easy to recall. But with respect to quoting the sections, the subsections.
As for that one, we are going to meet them. You see, if you get a past question, you see the marking scheme. You judge for yourself. For example, if there's a resident, I expect you to know everything under Article 4. Permanent establishment. They will not tell you that it's a.
No, so like I was saying the other time, you'll be able to present everything under maybe section 3 or section 4. But what about if the person quotes maybe according to section 2 of maybe Income Tax Act, but the person presents the thing well, but you know very well that the examiner knows that it is not section 2, but rather maybe section 3. But the student has been able to present the answers in a manner that is expected by the examiner or in the marking scheme. A person be marked wrong for quoting the wrong section by giving the right answers.
Yes, you'll be marked wrong. You see, the nature of the scenario question, the nature of the scenario question is that if you are asking you a question on residence, okay, you should know what residence is and what the rules are. A citizen, physically present in Ghana, employee, or a citizen temporarily absent from Ghana. You should know them. And it's an advice. Sometimes we ask you to write out. It's an advice. It's like a consultancy, something that when you get a past question and you see that, then you appreciate the way the answers looks like, and then you understand. Okay, but never mind. I bet you it is not difficult. Today, if I ask you what is a resident individual, you know that you are supposed to refer to section 101. If I ask you what is accessible income, you know that you are supposed to refer to section 3. It is not a record science at all. So don't entertain any fear like coronavirus. You'll be fine.
Timor.
Yeah.
Thank you very much. I think I'm happy with this innovation that has come about as a result of coronavirus. Yesterday and today, we have done our 2 weeks, isn't it?
Yes.
So I wish we could have more more time so that we can quickly run through this.
Are you saying if coronavirus passes away, we shouldn't meet?
No, we'll meet.
I
Yes,
like it,
yes.
Papa. The online is very effective. I like
It's
it.
very effective. Very effective.
Me too.
Trust me.
Oh,
So you see.
really?
So, what do we call? Timo, don't worry. We can move. You know, we are going online now. But I wish if all of us locked down next week, we can have some 2 or 3 more days, which means within 1 week we have done 5 weeks. Okay.
Yes.
And then we have 8 to 10 weeks before we realize 2 weeks we are done with the syllabus and we have time to practice. You know, as you said, this paper is not difficult, but the information overload is okay. There's a huge information overload, and for me, it's one of the interesting subjects that I've doing. But the information overload is a challenge.
Okay, I hear you. We'll see how
If next week,
coronavirus does
today
to our
is
lives.
Sunday, we can plan Monday, Tuesday. Within a week, we should have about some 2-3 meetings.
Yeah, we will meet, and so keep monitoring the platform. I will be posting some updates, and so that we can agree, and then we can make progress. Okay, at least in this period of quarantine, when you can't go anywhere, we'll use it to do most of our learning. Then even if it's over, then we can have time to meet one-on-one.
Okay.
All right, so please read the slides, and then let's see. You still owe me a reading of chapter 2 and 3 of the tax primer, because I tell you I have summarized a lot of things here. Yeah, chapter 2 and 3, the concept of residence and the whole thing, and that I have summarized them because I need to do that. So please read the chapter 2 and 3. I will keep asking. I will intentionally keep asking. And for international taxation, you need to be pushed to read. If I don't push you, you cannot read. So we'll meet again during the week, but I'll post it. If let's see what tomorrow goes. Tomorrow we can post another time, and then we say we are meeting. If we get a consensus, then we can have the class.
All right.
Okay.
Okay.
All right. So stay safe, then. Thank you very much.
Hello,
Sorry.
sir.
Yeah. Yeah,
Sir,
Nicholas.
can you share with us the constitution? Maybe can you put there on the platform? And then
Okay, I will share with
other ones are okay.
Go to
Sure.
Google.
Sure. I'll do
What
that.
do you call it?
I'll do that. Don't worry. I'll do that.
Play Store. You can
So
have
please,
it there.
yeah. So please, if we end, you have to hang up, and then you leave the meeting room. Then I can close the meeting. The last time, some people were still in the meeting room, so I couldn't close it. So when we finish, then you log off. And
Did you want to go?
Okay, that's fine.
yeah. So I couldn't close the room. When I'm closing it, it says some people are in the meeting room. So you just click leave, and then we can. So see you again very soon. Thank you very much.
Thank you.
Bye.